Test. Well, good afternoon, everyone. Glad you're able to join us for our webinar on retirement and tax planning and how to avoid unnecessary taxes, right? Everybody,
That.
so just a little bit about us. We're part of Ridgewood Financial Advisors, and within Ridgewood Financial Advisors, we have a couple of different brands organizations. One of them is Leads Tax and Accounting Services, and that's where Karen and Kevin are joining us from. And then myself representing Vision Retirement. So today we're going to take probably a better part of an hour. We have a lot of material to go through and go through that. This is who we are. In case you want a picture of us, you can take a screenshot of that. So we'll take, like I said, the better part of the hour here to go through the material. And if you have questions, we are taking questions. Ben is in the background here, and he will be answering the questions. So you can put them in the Q&A bar and feel free to go ahead and ask Ben whatever questions you want. If he can't answer them, he'll bring them to us, and we'll go ahead and answer them for the group. So without further ado, we'll go ahead and look at the agenda here. We're going to talk about after-tax savings. I think that's important. When we talk about taxes is, it's not how much you make, it's how much you keep in your pocket, right? So we want to talk about that. Social Security taxes, there's some changes around that a little bit with some senior deductions, which we'll talk about. Medicare taxes and the great IRMA that is surrounding it, some charitable giving, Roth conversions, and additional strategies. But before we get started, I want to break something, and there's a stigma out there that accountants aren't funny, but you two are. So, for the hundreds of people that are watching us today, I just want everybody to know that CPAs are funny. They're not funny on April 10th.
No, we are not funny on April 10th.
So, and I think that's where the stigma comes from, because you're seeing a lot of people during a very stressful period of time.
Yes.
And then they come back and they say, my CPA isn't funny.
Grumpy, even grumpy, yeah. I thought you were going to ask us to tell a joke. I was like, I am not prepared.
Well, we've come a long way from the vision of the green eye shades and the things on our arms and a
No pocket protector.
pocket protector or anything.
Yeah.
So there's a whole class in that Karen and I have taught of.
All right. We got that cleared, and I just wanted to publicly address that. So here we are, when we talk about 4 stages of retirement, and Karen, I knew you had some interesting thoughts on this as well when we were talking earlier, but practically the way we like to look at it is, you have your pre-retirement, and there's different things that you want to be focusing in on before retirement. You have your early retirement, right? The early years after you've crossed the line into retirement. The middle retirement, you start getting on, with age and everything else. And we have, late retirement. And the reason why we try to break it up is because the things that, if you're in the early retirement years, you're not thinking about the same type of taxes as you are in later retirement years. So, but, why don't you share with us, Karen, because you had some interesting thoughts about retirement and, how that really looks, especially with, my grandfather, and I use him sort of as the symbol of what retirement was. My grandfather worked for a company for 40 years. He retired on his 65th birthday. He got a gold watch.
Gold watch,
right?
Right.
They had a retirement dinner for him. And, there used to be an old rule of how much money do I need in retirement, and it would be 80% of your final year pay. And that was sort of a rule of thumb that people, went with for a long time. And, it dawned on me, that 80% came from my grandfather, because he had a pension that was equal to 50% of his salary.
Yep.
He had Social Security. My grandmother didn't work, so she had half of his Social Security. And when you did that math, it was almost 80% of what he was making.
Yeah, so when I was thinking about this webinar, I was thinking about, this is not your parents' retirement. It's not your grandparents' retirement, right? Retirement looks different now. It's actually, I want to kind of frame it a little differently. It's not an end, right? A lot of people think of it as an end, but with longevity, we have, 20 or 30 years where we, have these new opportunities to do things that we haven't gotten to do yet. So planning is really, really important, because you want to make sure that you have the ability to do those things that you want to do. So one of the things, just even in that first stage of pre-retirement, no matter what age you are, really, you want to start thinking about what you want your retirement to look like. So that's very individual. That's going to look differently for every single one of you probably, but you can set goals and you can talk about like what dreams are you ready to pursue now. How do you want to use the skills and the talents that you have in the future, because they don't just go away or disappear. And if it's things like traveling and volunteering, like create a bucket list and then sit down and think, okay, let's start planning. And that dreaming part about it is really important too. There are, of course, a lot of planning that has to happen, and it's really great to have the financial planner and the CPA working together, because planning financially and trying to get those taxes under control is really important. And when you are going to retire and, live for hopefully a long time, there are risks, right? I mean, we can't hide our head in the sand and pretend they don't exist. There's inflation and market volatility, rising healthcare costs, and even the fact that there's longevity poses risk itself, right? We have to make sure that our retirement is structured, our finances are structured in a way that allows us to do what we really want to do and pursue. So I kind of want to shatter the image of like, retirement being like, I got my watch, I'm going home, I'm just going to sit around, because that's not what people do.
Right.
That's not what you have to do. So it's kind of, if you think about it, it's just an exciting opportunity to turn the page, start a new chapter, and really think about, what you want to do with your time.
And I'm going to put Kevin on the spot because, your retirement is taking a new turn this year. You've been retired for about 15 years now, right?
Yes,
And
not really, but yes.
but you're taking a different turn in it, because what you're looking to do is to be here for your clients, but maybe not in person, right? So your bucket list is to continue to work and to continue to be available for your client base, but in order to do that, to do it in a different way and be more virtual and remote. So that's another bucket list type item that we talk about, because you love doing what you do. And in order to create that longevity and to be able to do that, you've made some changes on how you're operating with clients, which I think is great.
I've been saying for years that I don't want to work this hard, but I don't want to be home. And I don't mean that the wrong way. And this has, by merging, just let me stay and do the things I like to do.
Yep.
And still have the contact with clients, which I love to do, and help them and do all of that piece. Yet it takes some of the pressure and the things off, and I get some more time off. So
Yeah.
it would be better if the Eagles could win.
Well, I would just say, as far as the client meetings, with all of the tax changes and all the things that we're going to talk about today, it's going to allow you, not meeting in person, but having virtual meetings or calls after tax returns are prepared. It's really going to allow you to focus on more of the tax planning and more of the looking at what's actually happened, rather than doing it while you're trying to prepare the tax return. You have kind of a hindsight view. Okay, now that I've prepared it, now I can discuss what's going on with you. I think that will be really beneficial to clients.
Yeah. And then we're going to try and have meetings with clients that want to talk or need it after the fact, or over the summer and the fall, getting ready for the future years. One other comment I wanted to make is right now we're starting on the first thing you should start to do about thinking retirement. So too many clients come in and say, I'm retiring next week. Do you think I can?
Right. Yeah.
It's a planning process.
It's a real planning.
You think your wizard wand out and
It would be so much better, as we know, but so much better if we kind of did it a little bit before that, so you felt better. And the question that they ask, which is like a lot of times with clients, they ask the wrong question. You got to find the right one and what they need to know. But when I run out of money, and that depends on how well they, even at this point, schedule it and set it up.
Yeah.
So, and that's a good lead in here, Kevin, because we want to know what we've been so trained to save money in retirement plans, right? Because not like my grandfather. The world has changed, and companies have put the risk on the employees and taken it off the employers. So with that said, we've been trained to save as much money in our retirement plans at work, and we get, if we're doing it on a pre-tax basis, we're getting a tax, benefit from that. Maybe you can talk a little bit about, how when we save in a retirement plan, how does that impact, both our state and federal taxes? Because we have a couple partners that we work with when we're getting that nice little tax savings, right? So
Yeah.
maybe you could just elaborate a little bit about what does it mean to talk about after tax versus pre-tax, and how do we have to adjust our thinking?
This is a great example of what we're talking about. It's like you get a new job and you get a salary of $100,000 a year. After the first two checks, you realize that you're only going to get about 75. And it's the same thing with this. This is done nicely. We've been able to reduce our taxable income through our whole period of time that we're working. And now we turn around going to retire, but we're not going to get all that money without finally paying the tax on it.
Right, because it's tax deferred, not tax free, right? So exactly right. So, you're hopefully getting that tax deferment and not paying the tax while you're up in the higher tax brackets. Then you retire and you are taking it out of your retirement accounts and paying the tax at hopefully a lower rate, which leads to tax savings. If you have 500,000, like the example in your account, if you're saying, okay, I have 500,000, you're not taking into account the fact that you are going to pay tax on that.
Yep.
And that can be kind of painful.
Right.
If you take it out even earlier, if you need it before you're, 57 and a half, 59 and a half, you get another penalty on top of that 10%.
Yep.
So, we're past that with what we're talking about. Important to just keep in mind that 500,000 isn't really 500,000.
Yep.
So the tax can be significant. And then you're required to withdraw the RMDs, which can put you up into a higher tax bracket, making your
the RMDs are killers because, people don't realize, and they have been pushing it out, right? 70 and a half, 72, 73, and it's going to be 75. But what people don't realize all the time is that they haven't changed the table. So even though we're kicking the can down the road, we're having to take out a higher amount starting at 73 or 75. But the other thing that I want to touch on, Karen, and you said something that struck me is, hopefully we're paying or taking it out at a lower rate. Right. And I tell you, with the, especially now with the tax codes permanent till they're not, right? We're in a very low tax environment, right? I mean, you would agree with that, Kevin. You've been around and preparing taxes. So, this is truly a low tax environment. And I've been having a lot more conversations with people, and I want your thoughts on this about, if they do have the option to save in a Roth K or a Roth 401k or whatever, their retirement plan is, that, it's not necessarily such a slam dunk anymore to say, do the pre-tax, right? What are your thoughts, as it relates to this on, Roth contributions versus traditional contributions?
I've changed my mind somewhat. I wish that Roths were available 20 or 25 years ago when I started putting money into pension plans and stuff, but they weren't. And I think there's a way to maximize what that percentage is now. We're looking at 35 and 37%. I remember 50%.
Yeah.
Which is why a regular IRA was important. 50% was important.
Yeah.
I think you should kind of look at it each year and see where your rates are and
what is a better savings
now or later. I have the conversation with clients about putting it into the IRA and the rest, and even if they're not that ready for retirement, they'll say, but I can imagine making more money when I'm retired. And most of us wind up doing that because of all the things that happened. And so I think you almost have to do this every couple of years and figure out where you should be going. I have some clients that'll say, all right, here's what I anticipate the income is going to be for this year. How much can I take out of my Roth and keep it in a low, transfer it over, which makes all the sense.
And we're going to talk about Roth conversions a little bit later, but one of the reasons why Roth conversions has become so popular amongst retirees has to do with, the RMDs and the tax brackets. So, it's something that, it's not as much of a slam dunk anymore. And
I think it's part of the whole like one size doesn't fit all. You have to create your own roadmap idea, right? So like it is something that you should revisit. If you haven't visited it, visit it. But if you have, revisit it and see if anything's changed year to year.
Right.
Yeah.
Yep. So Social Security and Medicare, we heard, all through the campaign, no tax on tips, no tax on overtime, and no tax on Social Security. Well, two of those three worked out. There was a compromise on the Social Security. But the other thing, too, that we want to talk about as it relates to is, Medicare Part B is not free and your premiums are dependent upon your income. And, we do see a lot of people that once they hit minimum distribution age, that, those distributions that are coming in are increasing their Medicare premiums because of the IRMA, which we'll talk about. So let's talk a little bit about Social Security. Karen, I know that you don't like this. Another, I like the way it's taxed.
I don't particularly like that it's taxed at all, to be honest. But if you're an individual, first of all, New Jersey doesn't tax Social Security.
Or New York.
Or New York.
So
most of you out there, if you're in the New York, New Jersey area, you're not worried about the state tax. But individuals are going to pay no Social Security tax on their income below $25,000 if you're single. And then there's a threshold, threshold where 25 to 34%, 50% of your benefits are taxable, and then it goes up to 85% if you're over 34,000. If you're married filing joint, you don't really get the same benefit. And we were talking about this before it started. That first number, no tax on Social Security for incomes below 32,000. If you saw the individuals, it was 25. So you would think that should be 50, right? But it's not. Same kind of phase out. And then above 44,000, 85% of the benefits are taxable. So it's tricky. The new law that passed gives each person over $65,000 credit, presumably instead of giving you your Social Security for tax-free.
Yeah. So that's six. So within this year's going to be interesting with the SALT cap moving up. And for those of you that are not familiar with the SALT tax, it became very popular in 2017 when the new Jobs Act came out. But SALT stands for state and local tax.
Yeah, correct.
And we were able to deduct state and local taxes on our federal tax return, right? And I think people, they got so hung up, especially in areas where, real estate taxes are very high.
Oh, yeah.
But people lost sight of, state tax, which is a local tax, right? New York City tax, which is a local tax. So there's a lot more to SALT than just property taxes.
Yeah.
And so personal property tax.
Yeah.
So, so that's going to be a big thing this year, I think, because what I want to ask you about is the standard deduction this year is going to be how much?
Oh, you're putting me right on the spot. Yeah. 34,000?
Yeah.
Yeah. Married.
Yep. And so the senior deduction is on top of that.
On top of that. Yeah. And you don't have to itemize to get it.
So, I mean, really, we're looking at, as it relates to income here, you're at $34,000, forgetting about itemizing, just on, and so if I'm 65, I'm getting another 12,000 on top of that, right?
If you're married, yeah.
So I'm at 46,000 for a married couple that has that deduction. Does the 1,500 still count, or is that gobbled up?
That's part of it.
That's part of it.
No, it's an addition to that.
It's an addition.
My understanding is it's an addition.
So, I mean, as it relates to Social Security, it does help, right? That deduction will help people.
It will.
So it's going to be an important thing in my eyes to really look at, where am I at with itemization and where am I at with standard deductions?
Yeah, absolutely.
Because for, ever since 2017, I think it's 90% of the people have been taking the standard.
Yeah.
And
they did raise the standard, so it wasn't as if they took away, they limited SALT to 10,000 and then did nothing on the other side. They did increase the standard, but let's face it, the standard deduction is not 40,000, and that's what they raised the SALT.
Yep.
So if you are, working, paying state income tax and paying these high taxes in New Jersey, then you might very well reach that 40,000. And plus, if you have a mortgage, that raises it up too. So, yeah, I mean, that's very beneficial to people in,
Yep.
high real estate areas.
Yep.
$10,000 cap, which will come back, but while it's gone, it's going to be a boon.
Right.
It's going to be very helpful for people.
So then just to reiterate for everybody, I just want to make sure I heard what you said. If I itemize, I still am eligible for this senior deduction?
Yeah.
Yes.
So that's great.
Yeah.
And that is a home run then.
Yeah, it's almost like you have your cake and eat it too,
So
right? Like you're getting that itemizing, and that you're also getting that on top of it.
Right.
So very helpful.
It does phase out.
It does phase out.
For most people, it's fun.
Yeah, it does phase out.
So let's talk a little bit about Medicare and IRMA. I'm going to skip through this for a second here because I want to get into the meat of where we're at. But this is IRMA, right? And IRMA started showing up a number of years ago when nobody knew who she was.
That's right.
Monthly adjustment amount. I
Yep.
have to say it to
Yep.
know what it is.
And this is a big issue. And, we'll also talk about the widower's penalty. But in layman's terms, could, Kevin, let her take a break since she's caught talking. Do you want to just explain this at a reasonable level here so people can grasp it?
If your income in IRMA is really your adjusted gross income plus any tax-free interest that you may have. So it's basically, for most people, their adjusted gross income, which they can figure out and see where they are.
Mm-hmm.
And what it does is it adds a premium monthly on your cost of Part B and Part D. And as you see up here, if you make under 106,000, you just pay the normal
185,
185.
which is going to, I think, 290, something like that next year. So
And then as you go up the chart, you see that, from a certain amount, like for married 212 to 265, you're going to pay $74 more, et cetera, et cetera. And this is coming, we're getting the phone calls constantly saying, my Social Security went up by 3%, the net is less, and this is why.
the IRMA.
Yeah.
It sneaks in the back door on us.
And if you're married joint, that's for both. They both get hit with the premium. So it's not like, they don't split the income and if one's up and one's below, it's
Right.
both of you get it. So it's significant.
Yeah, and I think one of the issues with this as well is it's a cliff, right? You're always used to talking about phase outs and things like that. If you go $1, right, you go from 106, 105, 999. You go over that cliff and you're done.
Right.
And they look 2 years back, right, and they figure out what your income was.
25 was done on
23.
And so, we're, most people, once they understand IRMA, sort of become okay with it, right? It is what it is.
Yeah.
I think the issue that we see a lot are people get surprised by it, right? Because it's 2 years ago,
Yeah.
right? And now all of a sudden you're getting hit with premiums based on income that you may not even have, right? You may have sold a house, or you may have sold some stock, or maybe you cashed in some stock options or what have you. And sometimes it's one item that does it.
You can get relief.
Yeah.
If there's forms to file and say, hey, this was special year that this happened and that happened, and from then on I don't have that.
Yep.
And they will put it back to where it had been or closer to it. So
Yep.
they try to get that 1 year deal.
If it is really
A life changing.
like
It's
1 year,
life
changing event.
Otherwise, no, you're stuck with it.
And the form is SSA 44, I believe. And there's, I believe, 8 reasons to have that. So if you did have a life-changing event, death or, divorce, those kinds of things, you can look to appeal that. But the one thing that I also want to point out is that, again, this is if you're married filing joint, you're paying those premiums for each person, but the income is based on the joint return. And if we had a couple here and they were, making $200,000 between the couple, and one of the spouses passes away, but that income still stays at 200,000, we're paying 185, married filing joint at 200,000. At 200,000, their premiums are going up to 480.
Yeah.
Yeah, or even 591, depending on what side of that $200,000 thing.
And what did you call that?
I call it a widower's penalty.
Yeah.
Or, it's bad enough you lost a spouse and then,
Right.
all of a sudden you're having to pay 3 times the amount in, your Medicare premium. So, I just want to raise that awareness again. Obviously, it's not something that you can plan for, but, maybe there are things, looking at, when we look at Roth conversions or something like that, maybe there's some ways of, not just death, but also while you're alive to look at that.
Little things you can do for this.
Yeah.
We're going to see them.
Again, it applies to Part D as well. And the other thing, too, I want to point out is people think that if they go Medicare Advantage route instead of the Medicare route, that they can circumvent IRMA, but they can't. Whatever your income is applies to whatever Medicare route you take. So there is no getting around it. Somebody wants
No escaping IRMA.
See this. See, I told you were funny. All right, so let's go here. Charitable giving.
Go back to that real quick, I think. All right.
This one?
Yeah, we normally would think if you're going to sell stock, you worry
Mhm.
about what the capital gains is and the rest of it. But here you see, because of IRMA, it may cost you more than.
It's more than the stock sale.
Yeah. We used an outrageous example just to show, but yeah, this was, somebody wanting to just take out $1,000 and, it ends up costing them a lot of money. So, that is the idea is that, sometimes people will say, oh, you know what, I want to give, take $5,000 out of my IRA and give it to my grandson or,
Mhm.
Something like that. And it's a gift. And we see a lot of that, where it's, an extra $5,000, nobody's thinking about it, but it puts them over
Yep.
the limit and boom, there goes their Medicare premiums. And that's where people, when I talk about people not liking getting surprised by it, I've had conversations where people are going to get hit with IRMA because of, where they're taking money from. And as long as they know, it's like, all right, well, I still want to give the $5,000. But at least they know that they're going to get hit with it.
Right.
Because otherwise they show up in your office with the letter saying, what the hell's going on?
Exactly. What happened here, right?
The other thing is if there's ways to plan around that. Okay, so you're going to give $5,000 to the kids. Well, you take the money out all 1 year and then
Right.
distribute it.
And
So there's
distribute it.
ways to think about trying to.
Or don't take it out of that,
Right. Yeah. So
use different pot
Right,
of
yeah.
money.
Especially this time of the year, right? I mean, we have 3 weeks before the calendar turns here. And so, that calendar date can make a difference, right?
Yeah.
So don't give the gift on December 25th, give it on January 2nd.
2nd, right. It's a New Year
Right.
gift.
So, yeah, definitely ways to sort of think about that. So charitable giving, this has become, sort of a lost soul when the itemization went away. And so there was sort of a fix for it, but it's not a fix for, everybody if you're not itemizing. What are your thoughts, around charitable giving and charitable contributions and also qualified charitable distributions?
Yeah, I was gonna kick the qualified distributions back to you.
Perfect.
But the gifting, I mean, I think raising salt's gonna help because it will push people closer to the getting over the standard deduction. The other thing you can do is move your charity to like more in 1 year.
Mhm.
Maybe I've heard of people like, waiting, maybe not giving the 5,000 in December, but instead giving 5,000 in January and then 5,000 the next December. So now it's 10,000, right? So you just play with the dates.
Right.
And you're still doing the same amount of good, but you're taking it in the same tax year.
Mhm.
Ways to get you a benefit for what you're already doing.
Okay. And so with charitable giving, then, is there a difference if I give cash or stock, or what are some plays with charitable giving that can make a difference on a tax return?
Well, you can do stock and get a deduction for the current value
Yeah.
without having to pay
Gain.
capital gains on it. That's not part of what we're doing here, but that's one way to do it. The charitable giving thing through an RMD is, I think, one of the best things going on. Simply what it does is it says, okay, you had an RMD of $30,000 and you're going to give it to the church. Your income is now $30,000. So it helps on Irma. It helps on New Jersey because they don't see it.
Mhm.
So you're getting a deduction for charity that you would never get otherwise.
Mhm.
Right.
So most of the time by doing that, it's saving you half of what you're getting back. So it's,
Yeah.
Yeah.
especially if you were going to do it anyway. Or,
Yep. Yeah. So, the QCDs have been, again, another nice planning tool that came up. And this was primarily born out of the fact that people weren't itemizing anymore and charities weren't getting, the same
Yeah.
amount of money. So Congress came up with the QCD. But the limitations, there are a couple limitations, right? So when this passed, the minimum distribution age was 70 and a half. It's now 73, but the QCDs are still 70 and a half. So, people can do a QCD, based on the old RMD age of 70 and a half, which is nice because,
Yeah.
it gives them a couple of years there of reducing, some of their taxable income coming in. They can do up to, it's 108 now, $1,000 a year. So that's being indexed. So that's been
Great.
moving up. Yep. The second bullet point here, I want to have a conversation about because what it says is it must go directly to the charity, which is absolutely correct. It has to be payable to the charity, but you can receive the check as the donor and then pass it along to that charity however you want.
that's how I do it that way.
Yeah.
I say, mail it to me.
And I'll give it to the,
Yeah.
but the check cannot be made out to you.
Correct.
Right.
Yeah.
You cannot put it in your bank and then write a check.
Right.
That would be bad.
Yeah. Yep.
Yeah.
So, the reason why I say that is because one, I've seen people not get credit for their, it goes to the United Way, and
Right.
how many checks does the United Way get, right?
Mhm.
So I've seen the wrong Bob Smith get credited for the donation.
Right.
Bob Smith calls up and says, "Hey, I got this letter, but I didn't give any money."
Right.
Right. So, they're not even getting credit for it. And then just on you guys know that I'm on the fire department, and this time of the year, we do get, some QCDs that come in. And when they come directly in from the institution, it's like, nice, where others, will actually send a Christmas card and say, thank you for all you do. I just want you to have, use the enclosed check, blah, blah, blah. And the difference in what it makes, like, even to the person opening the envelope,
Mhm.
is impactful.
Of course. Yeah.
So it's nice that if you're, sending $1,000 to an organization that, you're actually giving it that finishing touch of saying, here you go, appreciate what you do. So it does help, the organization.
Ones I do, and it's from through Fidelity, and it'll come to St. Bonaventure University,
Mhm.
care of Kevin Leeds, and my address.
Exactly.
I didn't know you did that. Good for you.
Yeah.
Yeah. I do have a charity set up in my name.
I can step one up.
So that's great. So it doesn't count towards your income. You can, eliminate that hitting your tax.
Yeah, that's great.
And what we've learned with IRMA and also Social Security is that, as your income goes up, so does the taxes that you pay and, the premiums that you pay. So, the charitable deduction is great here without it hitting your income tax return.
Pardon me.
So we talked about that. All right. So let's keep going on. We're going to talk about just different ways of looking at tax versus tax-free. And sometimes we talk about it's not what you own, it's where you own it and these types of things. But really what I want to start talking about is, some of the issues around, qualified dividends versus non-qualified dividends, tax-free versus tax-deferred. So, conversations with clients, especially in years where they're getting a lot of dividend income and things like that. Do you have any conversations with them on anything that they might want to be looking at differently in order to help reduce some of that taxable income from this side?
Yeah, that's a great question.
Yeah, I mean, it's hard. The dividend piece,
Yeah.
well, the whole investment piece should be looked at. I guess the buzzword is what is tax efficient.
Mm-hmm.
Yeah.
Yeah.
And you can't do that on December 28th.
Right.
Right.
But one of the advantages we have is we share clients, so we have an idea
Yep.
that you can help us make sure that they've put them where things are.
Right. Because by the time we see the documents, it's done. So the only thing that we can really do is say, hey, for next year, let's do some planning and figure out what's more efficient for you tax-wise.
I know some of the mutual funds will send out, they've already sent them out, saying, this year your capital gains are.
You're going to get clobbered.
which then gives the client, if he reads it, it gives it to us a chance to
Mhm.
deal with it.
And mutual funds are not a tax efficient vehicle, right? I mean,
No.
so, sometimes, when we see clients that, they're generating a lot of, dividends, capital gains, things that they're not controlling, a lot of the times it's the vehicle, right?
Right.
It's just, is there a different vehicle that I can use? So that's one of the things that, we would talk about a client in that circumstances, because again, all of that income hitting a tax return, impacts all the things that we've talked about. Right?
Yeah.
Yeah.
If
Yeah.
you have a year where you have a lot of capital gains or a lot of dividend, we saw interest, people getting clobbered here with interest with the, going from basically 0 to 5%,
Right.
right? And,
Right.
people would have, $100,000 in savings, right? And they were
Right.
getting nothing, and all of a sudden they got,
Now they got
and that's taxes ordinary income.
Yeah.
There's nothing,
Yep.
nothing we can do.
drives up all the everything that comes.
Many clients who have the mutual funds and say, well, I didn't sell anything.
I shouldn't
Yeah.
have any taxes. I didn't sell anything.
Yes, the mutual
Churning the
fund
dividends.
Not
Churning,
necessarily-
wrong word.
Yeah, the right term.
Could be,
Yeah, it's some of that.
Yeah,
That's another
but
thing.
it's,
So- Right.
it's creating them.
And the other thing that, one step further with that, people will say, well, I don't take anything out of the account, but you bought and sold all year long.
Yep,
Right.
absolutely. And
It's a taxable event. And
one of the things that we're able to help people with it as it relates to interest rates is if you just, if you're able to make a IRA contribution or a Roth IRA contribution and just move the money, you can keep it in a CD or a money market, but just
Mhm.
move it from that individual account into a Roth account. And the benefit of the Roth account is that they always can get their savings back at any time for any reason without tax, without
Right.
penalty. So, we've had some circumstances where we had people that had, higher than normal savings. They were getting hit with interest. And again, it's, we always say it's not what you own, it's where you own it. So, just by making a Roth IRA contribution for a couple of years, getting $20,000, $30,000 out of that savings account, but still having access to it. And now that's growing.
And tax free.
And
Yeah.
so, that's one of the things that, we look at with tax-free assets and things like that, again, it's nothing more than moving the money, right? We didn't even have to make an investment
Right.
decision
Right.
or anything else like that.
Yeah. And so that's all part of that strategic planning that
Exactly.
to go on. And
Yeah.
it can't go on April 15th or April 13th.
Mhm.
And it can't go on December 28th. It
Mm.
has to be, something that is kind of continual.
Yep.
And really focused.
And that's one of the things that I'm excited about you guys as you, continue on to your 16th year of retirement. When did you stop teaching? 5 years. So you're in your 6th year of retirement. With that, and by spending more time after the tax return is done with clients, that's one of the things that we're looking to accomplish here is, the input side is, just nothing but a waste of time for everybody, right? Sitting. So if we can take that time where people are used to,
Right.
then, let us get the tax return built and then let's talk to you about it.
Right.
Because it's interesting, we talk to a lot of clients and, and we do a lot of teaching. And I'm surprised by how many people just take the do I owe, do I not? And they just throw it in the
Yes.
file cabinet and they haven't spent any time going through their tax return, and so, by you, creating more time for yourself and being able to, spend more time on the back end and, eliminating the appointments on the front end, these are the types of things that, we really want to start driving home for.
It's really a value add.
Yeah.
And I think initially people won't see it that way, but it really is something that is going to be more efficient and more
Mhm.
effective and really add value to that time spent.
And that time can be, in tax season or more than likely during the summer and in the
Right,
fall,
right.
which is great.
There goes your vacations. So we'll spend a little time here about, where to spend money. And this really gets into the Roth conversion conversation. But typical wisdom always used to be when you looked at somebody spending down assets, right? We would always look at, all right, what's already been taxed, right?
Right.
So in this case, the joint bank account has already been taxed. And then we would say, okay, well, where do we have other money? What's tax deferred? And then we would, look at the IRAs, right? And then we would say, okay, when all that's done, we'll take a look at the Roth IRAs because we want the Roth IRAs to grow as much as possible.
Right.
Because the benefit is really the growth on the Roth IRA, and then all of that is tax free. So, if you're a professor, teacher, and these are textbook items. Take joint, take IRAs and everything else. And with the way the tax law is right now, there's an opportunity because we are in a low tax environment to start thinking a little bit differently. So this was an example that we discuss here. And here's how we would want to normally spend it and then tax exempt money. But what if we do an alternate approach here? So in this example, what we're looking at is again still spending some of that taxable money. But then as we're in that low tax environment, because we don't have the income coming in from the IRAs yet, right? So we can start converting them, right? Putting them into Roths and then spend the tax deferred money until it's depleted. And then spend the tax exempt money.
Yeah.
The Roth conversion has been, a big conversation for a lot of folks, especially people that have already retired. And so for people that are out there today listening to us or banter, this is how a Roth IRA conversion works, right? Because some people, may not be as familiar with it if you haven't done it. But basically what we're going to be doing is taking money that's in a pre-tax traditional IRA account. We're going to move it over into a Roth account. That trigger by moving it from the traditional IRA over to the Roth IRA is going to generate a 1099, right? So now we've paid the tax on that money. And it also works better, if how do we pay that tax, right? So we have $100,000 of income. Maybe I owe $20,000 in taxes on it. Again, it works better if we're using non-IRA money to pay that taxes. So we want to get that full $100,000 into that Roth IRA, and then use it from there. I know this is one of your things that you like, but these are the tax brackets, and maybe you could explain what's happening here with a Roth conversion strategy, because some people think that I have to do it all at once, right? But that's not true, right?
Right.
So in this case, we're just filling up the buckets.
We're converting enough each year to keep us at a lower tax bracket, but getting money out of a situation that's going to be taxed at full blown when we take it out, handing it into the Roth so that you can slowly move most of it.
If I'm understanding it correctly, we're taking advantage of both the low tax universe we're in right now, or tax law, I should say, and also coupling that with the additional $6,000 of deduction for the Social Security and raised SALT. So all of those things together create a trifecta that allows a little more wiggle room to be looking at converting, and that this will raise your income, but those things will also offset it.
Right.
Yeah.
Okay.
Yeah.
So it's a really good time to start thinking about moving from taxable buckets into, non-tax, still paying the tax while stuff is low and can get that income down, and converting it so it can grow tax-free.
Yeah. Okay. And, one of the things that, people ask me is, who should be doing Roth conversions, right? I mean, and there isn't an easy answer to that, right?
Yeah.
But I'm going to say that probably 80% or more of the people that are doing them are in the 22 and the 24% tax bracket.
Right.
Okay.
That is sort of the sweet spot, because if you're up in the higher tax brackets, you're sort of playing Russian roulette a little bit.
Yeah.
But if we look at the 22 and the 24% tax bracket, the majority of that was the old 28.
Yep.
Right. So if we are in a situation where the tax code changes, right, I'm assuming the prior tax code is going to be a model to some degree of raising taxes. And so if I was gambling on this, I would say that if tax rates go up, the people that are in the 22 and 24% tax bracket would be in the 28.
Right. They're just going to move up.
So that's that. This is a real life case study here that we did. Kevin, thank you for allowing us to share this. But no, I'm just kidding. I'm the funny one. So what we're looking at here is one of the technologies we use to look at portfolio assets over lifetimes. So this is somebody's portfolio assets looking at over their lifetime. We have a couple of events down here. This is first spouse retiring, and then the second spouse retiring. And what we did was we did conversions where we reduced their portfolio assets by paying taxes in these early years. But these green bars in the later years are the benefit of doing the conversion. And so, it becomes a very powerful tool to say that, we're taking away a little bit now, for a later benefit. But one of the things that, this couple was interested in is that with the changes from the Secure Act and kids not being able to stretch out IRAs anymore, they wanted to leave their kids tax-free money. So they wanted to pay it at their rate and leave it, leave it to their children tax-free so that they didn't have to worry about the 10-year rule. Yep. And all the changes that have gone on with inheriting IRA money. So, it's a powerful, it has both present day benefits and it has, estate planning benefits. And, for people that are looking at doing Roth conversions, I don't want them to forget about, I'd rather receive 100,000 tax free than 100,000 taxable. Still tried to have the conversation with my dad over Thanksgiving. He's not interested in doing this for me. And he says he's too old, but, maybe if keep working on him for another couple of years.
I think one of the things with that shows how much it is on the one, the time to run out of money was what, 90 years, and now it's
three plus you gain
an extra 3 years of having money.
Amazing.
Yeah.
Right.
That's really what resonated with me when I saw this, because I hadn't seen this before looking at the slide. This was like, well, I need to do that, or I need to at least have this projection run for myself. And I'm excited to have that done.
Yeah.
Because there's a lot when you plan, there's a lot of things you can take advantage of. That's, I think, the key, right?
And we've actually done Roth conversions for folks where they've actually pushed off collecting Social Security and they spent down some of their taxable funds, did Roth conversions, and they were able to receive a higher Social Security benefit because they deferred until 70. And then what that also does is again, I always look at today and tomorrow. And from an estate planning standpoint, the surviving spouse keeps the higher check.
Yes.
Right. So if you have one spouse that is collecting, one spouse that's deferring, God forbid, or when anything happens to either one of them, the surviving spouse gets the higher check. So if that's the higher wage earner at 70, right, you have a much better survivor income than if you would have taken it earlier.
So even with that, even with the timing of Social Security, there's planning.
There is, we always say look for low income years, right, to do Roth conversions. So whether that's a year where you didn't get a bonus, business owners, a year where, sales were down and, you're not making as much. One spouse retires, the other spouse keeps working, whatever the circumstances are. But there's a lot of opportunity in low income years to think about Roth conversion from that standpoint. So we'll finish it up here, just looking at other ways of managing tax brackets. People have life insurance, maybe not as much as in the past, but, cash value life insurance has benefits to taking an income. So if you did have insurance out there that you could use for an income stream, again, that's tax free. If it's structured correctly, that may be a way for me to, lower my income and then do some Roth conversions as well. Selling appreciated stock, for lower no. So if you have stock that hasn't performed that well, you can look at that. And then again, we're looking at IRA distributions. If you are in lower rates. Just a couple of other tidbits here. Health savings accounts, funding those for retirement. Yep. Right. One of the benefits of the health savings accounts is that, you can use pre-tax dollars to pay for your Medicare item. So if you do have a HSA, and don't confuse this with the FSA. Right. Some people, there's still some confusion with folks around that, but health savings accounts, you put the money in there and it's yours.
Always there. It is not going to, disappear on December 31st like the FSA. So the HSA is a safer route for sure.
Absolutely. And then the QBI. I mean, we don't talk about the QBI a lot, but for those people that are self-employed or have their own business, the QBI was put in there to sort of level the playing field with the corporate tax.
Yep, absolutely.
And, I don't think it's talked about enough, quite honestly.
It's definitely helpful for our clients who have, businesses other than corporations that are getting that 21% tax rate. Yep. If you have a business that's taxed on your tax return, paying at your rate, this CPI can really help bring that tax rate down. So it has helped a lot of people.
Yep. So those are two things that we don't want people to forget about. So yeah, I mean, we want to make sure that, all of our clients, both on the accounting side and the advisory side, are being good stewards of minimizing their taxes, right?
Yeah.
And we like to minimize taxes because that's legal. We don't want to
Yes.
avoid taxes.
That's illegal.
Everything that we do is, we're looking to use things that are above the board,
Of course.
that are able to help people save on taxes. So, what
So-
are your closing thoughts?
I would just say that, think of it as an opportunity, right? Think about the fact that, your accounting firm or your financial planning firm has merged as an opportunity to take advantage of what a lot of people don't have, which is, a relationship between your tax advisor and your financial planner. That doesn't happen as often as you would think. A lot of good ideas come out of that. I would just say that just like with your health, you have to be your own advocate and ask questions and set up meetings and be proactive.
Yeah.
Because if you wait, the longer you wait, it's always possible to get help, of course, but the
Right.
sooner the better. So that would be my takeaway. Call us.
We're doing closing thoughts, Kevin. You can tell a joke and we can confirm that you're funny.
You're taking over. I think the one thing we don't often think about is taxation has become actually a family affair. And we were talking about in our state where, the taxable piece, the non-taxable piece. And if it's possible, if you can coordinate that with your beneficiaries, who are usually your kids, that what their income is, where they are. I have my youngest child is now retired.
Yeah.
I have one who's always been retired. So I think you can work some of that into your whole estate and even where you are doing and things now. It's changed so much since I started to take Social Security and stuff that, I would have done it differently and spent some of the other money and stuff.
Mhm.
But we didn't have the reduced tax levels at that point.
Yep.
And I wish Roth had been around a lot sooner.
The tax, it's funny, and I'll finish with this and you were saying how thick it is, right?
So yeah.
It's like that thick.
Like that. It's a whole
Yeah.
library. Like,
Yeah.
it's a whole wall in
Yeah.
the library.
I've written in English.
And
User friendly.
I look at it and I say, it's more complicated today,
No.
than it has ever been. And I'm sure that you can attest to that. And, one of the benefits of doing tax planning is that it can make a big impact. Like you said, we saw 3 years of additional money,
Right.
by doing some Roth conversions. That
Right.
was one thing.
Right.
Right. So there's so many tools available for us. And when we started out the conversation, we looked at 4 stages of retirement. And again, the reason why we break that out is exactly what you were saying, is the things that you're thinking about, at different stages of retirement is different, and the tools that you have is different.
Right.
So, a 40-year-old doesn't have the same availability as a 60-year-old. A 60-year-old doesn't have the same 80-year-old doesn't have the same as a
Right.
60-year-old. So it's all different, and it's not uniform. So, it really does matter where you're at and, what are the different tools that, you have available to you. So,
And things affect our net income, for one of the better, that we never thought about before. Irma being one of them.
yep.
Yeah.
So with that, we are over time, and I don't see Ben running in here with questions that we didn't get to. So if we didn't get to a question, we definitely will on the side. But I want to thank everybody for taking the time to listen to us today.
Thank you.
I want to thank you, Kevin and Karen,
Thank you.
for being here. And
Pleasure.
it's been truly fun, and looking forward to doing this again.
Yeah.
Yes.
Awesome.
Bye, everybody. Happy holidays.
Take care.